Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
We say they're blowing out, but the reality is they're moving back to where they should be. They should be much, much higher than Germany. That's the core problem of the euro, and the only problem of it coming apart wasn't if, it was only when, and when was the credit crunch. Once credit all of a sudden wasn't free any longer, the pressure started building in that zone, and people realized excuse me, that the other countries were just buying German goods with all that free credit and weren't building up and making their countries efficient or stronger with that free credit, which they were supposed to do. But we know what happens when we have free credit. We all go and party hardy. I think Jim Grant said it best, Interest Rate Observer. He said, humans cannot handle credit, period. And I thought, it was pretty well said. So we saw the dollar is really getting the major risk bid, and it continues to get that risk bid supporting it. And we ultimately think that the reason the dollar will stay in a multi-year bull market against these currencies, the other major currencies, and again, when I say that, the key currencies that make up the dollar index, obviously, the euro and the Japanese yen are the biggest weights within the dollar index. From a relative growth standpoint, we think once the U.S. gets through this period in here, and we may be getting through it, today was an interesting example of interest rates really soaring on this tax cut, where maybe the Obama administration is finally going to free up some capital to the real economy in here. On a relative growth standpoint, given what's going on in the Eurozone and given the continued crisis in Japan, we think the relative growth rates in the U.S. can finally start to improve, and that'll definitely improve that yield differential and be a real driver for the U.S. dollar long term, instead of just depending on risk bids in the world, which it's depended on lately. So that's our general thematic view of why I have a long-term bull market view in the U.S. dollar. And I can answer questions on that. This is excuse me, I apologize. Let me drink here. This is a chart that we continue to share with our members of our service. And let me go through it. It's pretty interesting. The black line represents the yield spread, which is noted over here on the right, between the 6-month U.S. Treasury and the 6-month Eurozone yield. Okay, so it's kind of the benchmark yields for 6 months in the two areas. And as the black line falls, it shows that the yield differential for the U.S. dollar is getting worse and worse. The red line is the U.S. dollar index. And it's interesting how when the yield differential falls, the U.S. dollar index falls. The yield differential rises, the U.S. dollar index rises. So this is a pretty tight comparison, which is an interesting point in that if we knew what interest rates were going to do, obviously we would know what the currency is going to do. We know neither, unfortunately, but we do know that there's a very, very tight correlation here. And one of the reasons, as I said, lately we've become more and more dollar bullish is given the latest Band-Aid fix in the Eurozone is going to call for the European Central Bank to do a lot more bond buying than they have been. All of a sudden, QE2 is coming to Europe in a very, very big way because the governments in Europe can't decide what to do or don't want to do what needs to be done, is put a stake through the heart of the euro. So Germany is no longer saying yes to everything, and Germany said no to the new Eurobond offering that they wanted to concoct. Germany said no to increasing the size of the stabilization fund. So therefore, the only thing left is for the European Central Bank to start buying more and more bonds, and they bought a bunch last week, and they probably bought a bunch this week. That tells us that the relative interest rates, we think, on the short-term side, 6-month, 3 months, will tend to fall in the euro relative to the U.S. So we expect this spread to start moving back up meaning becoming more positive for U.S. deposits relative to Eurozone deposits, and we expect the U.S. dollar index to follow. So this is not only just a pure just correlation, but there's also some fundamentals behind this idea. So this is one of the reasons, just another reason we think this yield support, the dollars, may start getting in a big way. And as I said, if you look at what happened to the bond market today, I think we had long bonds. I don't know what happened to the short end, but we had long bonds down over 2 full points today, the 30-year. Big move. And I think some of it, as I said, is sparked by this idea that we're going to get, that Obama's going to get serious about the economy in here, being forced to. He was basically, committing political suicide, I think, and maybe some of the grown-ups in the Democratic Party, if there is such a thing in either party, went to him and said, you got to start moving to the center, as Clinton did after the midterm election, and I think this is positive for the U.S. economy. And again, I don't want to overplay this. There could be other things short term, but part of this we think is in this move in interest rates today. So interest rates in the U.S. moving higher just tend to give the dollar more yield support, and you can see how important this seems to be, this yield support, just by this chart alone. This is our view of the dollar index here. As I said, we started to get real bullish again. Actually, we were bullish when we thought the dollar had bottomed on that credit crunch day on March 17th, which it did. It put in its low, but this came down and tested it here last November in a very big way, and most people thought we were going to fall back into the bear market, but the dollar has since bounced, as we've seen, and we think this is just the beginning of a big move up in the U.S. dollar. What we have on here are just some of our wave charts, looking at this as an ABC corrective move here in the U.S. dollar on a daily basis, and this is just our stylized pattern of where we think the dollar moves on this next wave up into the 90 level in the U.S. dollar index. And based on price action today, we're feeling a little bit better about this. But from a correction standpoint, back into 78 range wouldn't have been unusual, but we've seemed to get a bounce. So if we update this chart for today, we're probably back up in here on the U.S. dollar index. Let me see, we're at 79.90. So had a nice little bounce today on the U.S. dollar, and we think it will continue. Euro bearish, as I said. Germany is finally saying no, and we've been talking about this for a long time. It's now becoming to the point where it's a political question as much as it's an economic question for Germany. Merkel is getting a lot of pressure, as she should by her own citizens, her own taxpayers, that are continuing to foot the bill for the Eurozone. And as I said, the original incentive for the Germany to start and give up their D-mark was the fact that the industrialists created a captive market for all their goods. They knew that none of the countries in the Eurozone on a relative basis were going to be as efficient as they were. So they were basically going to own the Euro continent from an export standpoint, and the Euro itself made that much easier for German industry. Now, that may sound greedy on Germany's part. It is to a degree, but same token, Germany has subsidized these countries in a very, very big way in order to keep this game alive, but it's created incentives for them. And if you do a pure, valuation bet, which is something that the Germans are very, very good at, the relative incentives outweighed the cost to them. We're now at a situation, given the decline in these countries and the austerity that's settling over, especially the southern tier countries, and all the problems in the zone, and this idea of trying to create a Eurobond, which effectively would push up German interest rates and cost their companies more, which is why Merkel said no way to that idea. I said from a political standpoint, the incentives for Germany staying in the system have fallen tremendously. And also, given the fact that China is now the biggest growth area for Germany, that's another reason the incentives for the euro, the single currency for Germany, has fallen also.
Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.